The stock market isn't just dipping anymore, it's bleeding. Trillions in paper wealth have been shaved off in weeks. AI darlings are getting crushed, and the buy the dip crowd suddenly looks very quiet. And while everyone's busy arguing about rate cuts and earnings, the real action is happening where DC politics, AI surveillance, immigration, and national security contracts collide. That's the part that can quietly remake entire sectors of the market and your portfolio over the next few years. By the end of this video, you'll know 3 things: what's actually driving this sell-off beyond the headlines, how the DC AI national security triangle is reshaping risk and opportunity, and what I'm personally watching and doing next instead of panicking with the herd. Here's where things get interesting. Let's start with what's really happening right now. We've got an AI-led market that ran way ahead of earnings, priced for perfection, and then, shocker, reality showed up. Growth is slowing at the edges, margins are getting squeezed by massive AI infrastructure costs, and suddenly the same stocks that could only go up are down 20–40% from their highs. At the same time, you've got sticky inflation, a Federal Reserve that talks data-dependent, but clearly does not want to reignite a 1970s rerun, and a bond market that keeps whispering, hey, these risk-free yields don't look so bad compared to your favorite money-losing growth stock. But it's even getting worse because this isn't just about earnings and interest rates. Underneath, AI is going through its deal with the government phase. Think big tech signing massive contracts with defense, intelligence, and law enforcement agencies. Think AI for border surveillance, facial recognition, and predictive policing. On paper, that's recurring revenue and visibility. In practice, it's also political risk, regulatory risk, and reputational risk packed into the same stocks your tech ETF probably owns. Here's the twist. Every time DC fights about immigration, border security, or national security, those debates now have a hidden line item: AI contracts. When Congress drags a tech CEO in for hearings, it's not just about content moderation anymore. It's explain this shadow AI system you're selling to federal agencies and how it's being used. And here's where things take a step further. If you're a politically engaged investor, that means you can't just look at PE ratios and say, looks cheap. You have to ask, is this company about to become a political football? Let me give you a personal angle. When I was about 12, my parents lost most of their savings because they trusted a bank advisor who said, "Don't worry, it's safe. No drama, no screaming, just a lot of very quiet dinners." That's when I learned experts can be wrong, and by the time you feel the pain, the incentives that caused it are already baked in. Today, the experts are telling you AI is the future. Government contracts are sticky, and this is all just noise. Maybe. Or maybe we're in the early phase of an AI security surveillance complex that will look brilliant in a spreadsheet. Right up until there's a political backlash, a privacy scandal, or a major regulatory hit. But then the unbelievable thing happened. We started to see something that almost never happens at the same time. Tech rolling over while defense and surveillance-linked names quietly hold up or even rally on bad news. Markets are basically saying, we still like AI, but we like it with a Pentagon budget behind it, not some consumer app that might get banned in 3 countries next week. So what are the key takeaways from this deeper sell-off? First, this is not a random crash. It's a repricing of hype versus cash flow. AI infrastructure is insanely expensive. Companies chasing that dream are spending like crazy on chips, data centers, and power, while investors suddenly remember that profits matter. Second, policy risk is no longer a side story. If a company's growth narrative depends on aggressive data collection, biometric surveillance, or cozy security contracts with vague oversight, it's also exposed to the next election cycle, the next scandal, and the next round of hearings. Third, in this phase of the cycle, markets are starting to reward boring again. Cash, real earnings, low leverage, and businesses that don't depend on a 300-page regulation staying untouched for 10 years. Here's where things get interesting. I learned that lesson in my early 30s when I invested in something incredibly boring while everyone else chased the hot, shiny thing. It didn't 10x, it just worked. Slowly. While some of the can't-lose trades around me went to zero. So how do you translate all of this into a plan instead of just doom-scrolling stock charts? Start with a simple framework. 1. Separate your watch list into 3 buckets: AI hype, AI infrastructure, and AI plus government security. AI hype is your story stocks, cool demos, weak cash flow. In a sell-off, these get crushed the most and stay down the longest. AI infrastructure is chips, cloud, networking, energy. These names can fall hard too, but they're attached to real demand. AI plus government security is the weird one. These companies can benefit from long-term contracts, but also take the blowback if civil liberties become a political flashpoint. 2. Map policy risk. If you follow DC, immigration debates, and national security rhetoric, you actually have an edge here. When you hear a new bill about data privacy or facial recognition, ask, whose margins does this hit if it passes? Whose contracts get bigger if fear goes up? But then he said this unbelievable thing. When I worked part-time at a local newspaper in college, I watched editors rewrite the same economic story 3 different ways just by changing the headline. Same facts, totally different mood. That's how your portfolio gets whipsawed, by framing, not just data. So don't let every scary headline push you into emotional trades. Look at the incentives behind the story. Who benefits if you panic? In terms of how I plan to invest. Here's what I'm doing. I'm keeping a watch list of high-quality AI and infrastructure names I actually want to own for 5 to 10 years. Companies with real cash flow and diversified customers, not single-point-of-failure government deals. During this kind of sell-off, I don't chase falling knives, but I do start building positions in stages when valuations reconnect with reality. On the DC and national security side, I'm treating those plays as higher risk, higher politics. That means smaller position sizes, higher expected volatility, and a willingness to walk away the moment the risk-reward shifts because of regulation or public backlash. And in the middle of all this, I'm still boring on purpose. Strong balance sheets, real earnings, diversified revenue streams. Because every time someone yells once-in-a-lifetime opportunity, I remember my layoff in my early 40s, explained as a strategic realignment. Sounds smart. Translates to, you're fired. Here's where things get interesting. If you're watching this thinking, I'd love to talk about this stuff on YouTube, but I don't want to be on camera. That's literally how this channel runs. This video was created with Fludge.io, the same system that powers this entire channel. It researches topics, writes scripts, builds thumbnails, pairs everything with an AI avatar, and uploads to YouTube. You stay in control. You can jump in at any step, tweak the research, rewrite the script, or even record your own video and let the system handle the rest. So if you want to run a serious channel in finance, news, politics, or anything else without doing all the grunt work yourself, take a look at Fludge.io. It removes friction but doesn't remove quality, which in this algorithm is the only real edge you have. But then the unbelievable thing happened. Let's land this. This sell-off will end. They always do. The question is, who comes out stronger on the other side? Investors who understand how AI, DC politics, immigration fights, and national security spending interact are going to see risks and opportunities before they show up in the price targets. Everyone else will just blame volatility and move on. My suggestion, use this moment to clean up your portfolio. Cut the positions where your entire thesis was number go up. Size down the names that are one scandal away from congressional hearings. Build watch lists around real earnings, clear policy exposure, and durable demand. And then do the hardest thing in investing. Sit still long enough for a rational plan to actually work. Quick disclaimer before we wrap, nothing here is personalized financial advice. I don't know your risk tolerance, your time horizon, or whether you panic sell the moment a stock drops 5%. Use this as information, then make your own decisions, or talk to a professional who actually knows your situation. If you found this helpful, hit like so more people see it, subscribe to the comment section with Thomas Paul for more deep dives on where markets, AI, and politics collide, and drop a comment below. Are you buying this sell-off, raising cash, or just watching the fireworks from the sidelines? I read the comments, and sometimes they're better than the headlines.